FICO has one of the strongest business models I've ever seen, but its stock is down 57% from its all-time high, and investors are panicking. The fear? Government regulators are trying to break FICO's stranglehold on credit scores. But when I dug into what's actually happening, I think the market is getting this completely wrong. And I'm going to show you exactly why I believe FICO stock will double from here. First, if we look at this chart of FICO's revenue by business segment, we can see that just over half of the business is in credit scores. However, this segment makes up 2/3 of the company's profit because it carries dramatically higher margins than its software segment. That's why shifting government regulation is key to the FICO thesis. If the government encourages greater competition in credit scores, it could lead to FICO losing market share. Speaking of competition, for decades, FICO was the mandatory scoring model for mortgages across the United States. But since 2025, the FHFA allows VantageScore as an alternative. VantageScore is a joint venture between the three main credit bureaus, Equifax, Experian, and TransUnion. These credit bureaus are actually responsible for much of FICO's business because they package the FICO score in their own credit reports, which are then sold on to the resellers. However, the credit bureaus have been pricing their VantageScore offer aggressively for as little as $1 per score versus FICO's $4.95 per score. This move by the credit bureaus added to investor fears around FICO stock. But to me, this aggressive pricing just indicates that they're struggling to gain adoption by lenders for their scoring model. FICO still accounts for 90% of the lending market. And the reason for VantageScore's failure in this regard is FICO's deep integration in the lending market. FICO became the default credit scoring system because the US lending market was engineered to depend on a single standardized risk model. Mortgages are packaged and resold to the secondary market. These investors have used FICO as their universal scoring model for decades. FICO has basically become the language of mortgage risk. So despite government efforts to provide competition in mortgage lending, the investors will ultimately go with what they already know and trust. This deeply embedded trust has allowed FICO to flex its pricing muscles, raising prices from just 60 cents per score back in 2018 to $4.95 per score today, a more than 700% increase in 8 years. This led FICO's operating margin to expand from 17% in 2018 to 46% today. And there's reason to believe that this incredible growth can continue. The strongest justification for continued pricing growth is that the FICO score costs $4.95, which accounts for less than 0.08% of the total mortgage closing costs, which average around $6,000. FICO could quadruple its fee to $20 per score and still average 0.33% of the total mortgage closing costs. Even when compared to the credit bureau's tri-merge report, which contains the FICO score, it accounts for less than 15%. Now, if we turn our attention to FICO's fundamentals, we can see from the company's revenue chart the effect of those price increases. You can see that the 10-year average revenue growth is lower at 9% than the past 2 years, where revenue growth has accelerated to 15%. In that period, there's been organic volume growth, but pricing seems like the primary growth lever for FICO. And if we compare FICO's revenue to its operating margin, we can see that over time, not only is revenue growth accelerating, but the quality of that revenue is increasing as well. In the past 5 years, revenue grew from $1.36 billion to $2.06 billion, and FICO's operating margin expanded from 35.3% to 47.5%. That expansion in operating margin has a leveraged effect on profits, and that leveraged effect can be seen by looking at FICO's free cash flow. Instead of the 9 to 10% growth in revenue, we see average free cash flow growth over the past 5 years of 15% and a 2-year average of 22%. The 1-year growth signals a slowdown linked to slowing software revenue. Another factor that's impacted the FICO investment thesis is their share buyback program. FICO consistently buys back its own shares to increase the value of the remaining shares. One thing that might concern you is FICO's debt, which has been growing consistently over the years, reaching $2.8 billion recently. You might be thinking, how can FICO be making so much money, yet also be taking on so much more debt? The answer is that FICO uses debt strategically. They can borrow fixed rate, long duration debt to lock in low interest rates, which they then deploy into share buybacks. This makes sense because if they can borrow at 5% and buy back shares, the long-term return could be 15% on those shares, meaning that they create 10% extra value for shareholders. And we can see the impact of those share buybacks by looking at FICO's free cash flow per share. It grew at nearly 20% over the past 5 years, an extra 5% on top of free cash flow growth because they shrunk the amount of shares outstanding along the way. Free cash flow per share is really the true indicator of a company's ability to create value for shareholders. In terms of catalysts for FICO stock to rebound, they recently announced their DLP, or Mortgage Direct Licensing Program. This is FICO's attempt to sidestep those pesky credit bureaus and go straight to the resellers, allowing them to license scores directly from FICO. And the good news is that approximately 70 to 80% of the reseller market is already on board according to FICO's recent earnings call. This program will allow FICO to capture the economics that used to go to the bureaus, who are now competing against FICO with Vantage Score. So all their complaints about FICO's pricing has severely backfired. Instead of making money by marking up the FICO score on their tri-merge credit reports, the credit bureaus will have to go toe-to-toe for the reseller market. And then we have FICO's new scoring model 10T. FICO Score 10T is described as a significant step forward in credit risk assessment with improved predictive accuracy, fairness, and model stability versus alternatives. The company has nearly doubled the number of lenders in the FICO 10T adopter program over the last year, and lenders in FICO's 10T program represent more than $377 billion in annual originations and $1.6 trillion in eligible servicing volume. So this is a huge portion of FICO's potential customer pool. And then there's interest rates, which are a major potential catalyst for FICO stock because lower interest rates directly increases mortgage originations. And that mortgage volume is the second lever in FICO's revenue engine. Even though pricing has been the primary driver of growth in recent years, volume is a multiplier. When rates fall, that multiplier kicks in. When interest rates fall, the housing market goes to work. People start buying new homes and refinancing their existing mortgages, which all run through FICO's scoring model. But then there's the risks. And as of late, these are the sticking points that investors are genuinely scared of. Government regulation is the threat that can move the stock up or down 20% in a single day. There's a real possibility that FICO's pricing power is capped by the government. Senator Josh Hawley has already urged the DOJ to investigate FICO's mortgage score pricing, calling it a monopoly abuse and highlighting the 40% price hike from $3.50 to $4.95 per score. Hawley argues that FICO's pricing is an abuse of its market dominance and burdens borrowers. The probe could target FICO's new pricing model and its direct licensing program. Any pricing caps would certainly send the stock tumbling. And I think that may be priced in already to a certain degree. And then there's those pesky credit bureaus. Their attempts to increase Vantage Score's market share hasn't succeeded so far. But with their new $1 per score offer, maybe they'll get some new clients on board. Even if Vantage Score fails to gain wide-scale adoption, their offering puts pressure on FICO's pricing power. And then there's rising interest rates. Rising interest rates pose a threat to FICO because they suppress lending activity, increase consumer financial stress, and reduce the volume of credit score pools. If the housing market grinds to a halt, FICO's growth will slow down with it. Alright, now it's time for your favorite part of the show. We're going to explore FICO's current valuation and then use Qualtrim's DCF calculator to see what kind of return the stock could produce from today's price. First, we'll look at FICO's price to earnings ratio. As you can see here, the stock currently trades at 21 times its forward earnings and 19 times its 2027 earnings projections. This is right around the same valuation as Equifax, one of the three credit bureaus who own Vantage Score, but they ultimately have a much weaker business than FICO. So the fact that FICO trades at a similar valuation suggests that it could be undervalued. Then if we look at FICO's price to earnings ratio over the past 10 years, it's trading at around or slightly below the midpoint. This suggests that the stock is possibly fairly valued, but you have to remember that FICO's operating margin has more than doubled over the past 10 years. This justifies a higher valuation over time. If we take a look at FICO's free cash flow yield, we see it's trading at roughly 3%. Historically speaking, this is quite low, suggesting the stock could be overvalued, but again, we have to remember that the business quality has improved dramatically over the past 10 years. The 1% free cash flow yield in 2024 was quite frankly overvalued, which may explain why the stock has had such a dramatic fall over the past year. Right, now for the juicy part. We're going to estimate FICO's potential return using Qualtrics' DCF calculator. I'm going to give you my base case for FICO stock. I think the result will be quite surprising. As we can see from the chart, FICO's free cash flow yield usually sits around 3%. And I think that's a good base assumption for the valuation multiple. It's the exact same free cash flow yield that the stock trades at today, so we aren't relying on multiple expansion at all for our future return here. So now in terms of free cash flow per share, I'm not expecting the highs of 24% like the past 2 years, or even the 20% over the past 5. But the 12% over the past year seems low when you factor in some margin expansion through price increases and continued or maybe even accelerated share buybacks. So I think a 15% free cash flow per share growth over the next 5 years is incredibly reasonable. And with those base assumptions, you can expect FICO stock to return over 15% per year over the next 5 years, more than doubling from today's share price of just over $1,000 to $2,080 per share in 2031.